Analysts have been downgrading CNQ, talking about how it's no longer the valuable and great value stock pick that it was just a couple months ago. Today, my question: what is it that they know that the rest of the market doesn't? Why are they so bearish on CNQ? And why have they picked Suncor and Imperial Oil over CNQ to outperform? In today's video, I'm going to cover a couple of recent articles talking about this question, and I'm going to give my thoughts on what analysts are looking for, what they're looking at, and why I disagree. Welcome to Golden Arch Investing. My name's Liam. If you enjoy this kind of content, you want to talk more about Canadian investing, please do subscribe to the channel. Let's jump right into the question today. What exactly is it that analysts are saying? We're going to start on Yahoo Finance. I'll put this up on the screen right now. Canadian Natural Resources downgraded, Suncor and Imperial boosted to buy. It's an article by Jeff Lagerquist, and he's talking about some specific analyst targets, and specifically the analyst is based in Houston, and they've downgraded Canadian Natural Resources stock from buy, where they're saying it's a good opportunity now, to hold, which means that we don't know. It's kind of the first step before saying sell from an analyst perspective. And downgrades like this do have an impact on stock price, on the sort of willingness of different funds to hold stocks like this. So it is a big deal for some stocks, particularly big resource stocks like this. So Canadian Natural Resources, CNQ, shares were downgraded by TPH & Co. on Monday, which is the analyst. They've joined a growing camp of analysts favoring Suncor Energy and Imperial Oil amid the risk of U.S. tariffs and on Canadian crude. So, of course, nobody can talk about investing in Canada without the backdrop of drama, tariffs, threats, stress, anxiety. That's all people are talking about. And this analyst seems to be saying that Canadian Natural is particularly exposed to this risk. Joffrey cites valuation concerns as he lowered his recommendations on Canadian Natural Resources stock from buy to hold, but he's maintaining a $50 per share price target, which is several dollars a share higher than the current stock price, I will say. So it is interesting that he is going from buy to hold, and yet he's not changing his price target. So that tells me right away that there's something going on that he's thinking about that isn't necessarily anything to do with the long-term vision for the company. And it's more so about him preferring another company. Specifically in this case, he talks about Suncor and Imperial, which he has the opposite flip, where he's going from hold to buy with price targets of $66 and $115 per share respectively, which is, again, a little bit of upside for both of those companies, obviously, if he's calling for a buy. He says, we view CNQ's asset quality and reliable execution as world-class. We see recent weakness and more noise-related versus structural. So it's about the noise. It's about the drama. That's why he's downgraded, which I think is kind of interesting. And he's moving to the sidelines on valuation. I'll finish out sort of what we're talking about here. Looking ahead, we don't doubt CNQ's ability to continue crushing the quarters. 2025 could bring further operational improvement following recent transactions. All positive, but for now, see better rate of change potential elsewhere among Canadian seniors. And this is the current stock price. So obviously, between $43 and $50, there's still a lot of room to grow. But you see in the last 5 years, we're looking at the charts of these various companies. CNQ is the middle line here, up a good amount. Imperial is up more. Suncor is up significantly less. The CEO of Suncor mentions that their company is best positioned in Canada's space to withstand a trade war. Boasts on the conference call that Suncor has hit several internal milestones earlier than expected, and he says that they're sort of the league MVP, and he's owing a lot of that to the respective refining and fuel marketing business in Canada, and they say that sort of that, as well as to Imperial, that'll keep them away from some of the risk. We have sort of more stuff going on, and sorry that they're going to keep popping up. They're going to keep trying to make me watch whatever's going on. Anyways, so what do I see in this article? Well, I really do want to go back up a little bit here and just highlight one thing. Noise related. This is all about the threat of tariffs, because CNQ is the largest Canadian producer of crude oil, obviously a huge amount of their business going to the States. They are the most exposed to tariffs. And that's obviously not a good thing. We don't want any companies in our portfolios that are going to be damaged by macroeconomic events. That sucks. But they are also the most likely to benefit from change in the market. What basically the analyst is saying here is that Suncor and Imperial are a little bit more sort of self-controlled, self-sustainable. I don't know what word I would use to describe that, but they're a little bit more insulated. They're protected. They're not as dependent. They're not just doing one thing, which is production. They're also refining, and they're a little bit more senior. They have a little bit more years of experience, years of optimization on their side. And they're saying that CNQ, it's been growing fast. It's been making acquisitions. It's sort of the big name. It's the big player, but it's really all about production. And then it ships all that oil down to the States. And therefore, it will be hurt by the trade wars. And I'm not going to question that. I think 100% a trade war will hurt CNQ. I do think that considering what's been happening with constant news about, oh, this is going to happen. No, wait, this. No, wait, this. No, wait, this. That there's a lot of fear about trade wars that might become justified or might not. And we have no real way of telling because there's no sort of consistent, stable direction that this whole trade war discussion is going in. But my question is, why should I care? If CNQ is going to be the at-scale provider and they're going to continue to grow and they're going to continue to optimize. And yeah, okay, there's going to be some price challenges, but they're going to continue to push through. Then isn't this a buying opportunity? I'm really confused. Why would an analyst look at a company like this and say, hey, I care about the noise-related short term over the potential long term? I mean, for the first time in my adult life, Canadians across the country are calling for pipelines to the oceans. We're talking about building all sorts of infrastructure around energy in this country. We're talking about making it like a national priority. 2 years ago, most of those same Canadians would have protested any pipeline being built, and some of them did. And yet we're still talking about how the noise-related challenges of the United States are going to hold back this company. I'm really confused about that. And also, my question is, what is it really about Suncor and Imperial that makes them better long-term value propositions? Yeah, okay, they're more self-sustained. They are less dependent on the United States. But everybody knows that. And so the second this tariff news was out there, people started to shift their positions. If you're a short-term swing trader, you knew this already and you've made your profit and exited your trade. So what's left for the rest of us? Are we hoping that their overperformance, outperformance, their increased amount of profitability in contrast with the market will let them find some sort of strategic advantage in the near future? Are we saying that they're the ones that are going to be able to buy assets at discounted prices? I don't know. I also don't know why we're so concerned about these companies. I mean, it's literally in the article on the screen right now that CNQ's asset quality and reliable execution is world class. It's not like we're going to talk solvency here. So isn't this a buying opportunity? That's just what I'm confused about. To understand this a little bit better, I wanted to dig into why exactly people are preferring Suncor and Imperial. So I'm going to hop over. I'm going to look at that right now. Exact same author here. He actually linked this in the introduction to the previous article. Talks about Suncor Energy and Imperial Oil as top picks. This is obviously a couple weeks old now, January 30th. But very valid. And he talks about Canada's largest oil and gas producers due to be reporting fourth quarter financial results this week. Analysts say U.S. President Donald Trump's tariff threats will be an ominous distraction from the industry's solid performance in the final months of 2024. Imperial Oil is the first major Calgary-based producer scheduled to report Q4 financial earnings. Suncor results are due on Feb 6th. Cenovus is scheduled to report Feb 20th. So far, so good in those earnings, I should say. Things have gone pretty good for the overall market. RBC Capital Markets estimates free cash flow from Canadian oil sand weighted majors. Canadian Natural, Suncor, Cenovus, and Imperial topped $5.2 billion in the fourth quarter, which is down considerably from Q3. Setup for Canada's oil weighted producers in 2024 was one of the best we'd seen for more than a decade. Balance sheets are strong and capital discipline is holding the line. And of course, many of the oil majors in Canada are distributing 100% of their free cash flows. Scotiabank is saying that cash flow per share estimates for the quarter are 1 cent below street consensus due to weaker realized prices. U.S. benchmark crude averaged $70-ish, which is down about $5 or 7% sequentially. RBC Capital Markets estimates companies in the sector repurchased about 3.1 billion, down from 3.4 billion. So, okay, they're saying lots of return of capital, prices are dropping a little bit, but they're in a really good capital position and they're able to return a lot of shares, or return a lot of value, I guess, to shareholders. Earlier this month, Canadian producers responded to Trump's increasingly harsh stance on trade by rolling out bigger production plans for 2025. They see improving demand and higher prices on the horizon due to the expansion of Trans Mountain Pipeline. Obviously, I mean, when we put ourselves in the headspace of January 30th, we don't know that the sort of debate about pipelines is about to blow up. So I would say it's probably even more optimistic now. I don't know. I guess we're going to wait and see, right? If people that are reporting next week, like Cenovus, are going to mention that. Might be interesting. Canadian oil and gas equities have underperformed their U.S. peers year to date due to uncertainty. Within the Canadian oil and gas, integrated companies have fared relatively better and they're perceived to be less impacted by potential tariffs and export taxes. Suncor is the favorite from this analyst, and Imperial is sort of up there as well. Imperial is also majority owned by American oil giant Exxon, produces with their U.S. international operations of less tariff exposure. And basically, what they're saying here is that production is ramping up and they're seeing better sort of distribution. They're seeing better opportunities in some spaces. And specifically, they like these integrated companies. They think they will survive better, mainly because they're less dependent on the United States. And they don't really go into any extra detail, right? I mean, we just read the linked article that was supposed to be the source arguing why Suncor is a better pick. Apart from them saying that it's a better pick, what evidence do they give? We just read through that entire article. What do they say that actually makes you think, okay, yeah, the company that's growing slower is definitely a better choice for me? I mean, I would just love to see a little bit more option here. I would love to see some of the sorts of arguments about why long-term those companies are going to outperform. Yes, they have more moving parts in the business, which is why they don't really grow as fast. They can't expand as quickly. They're not just doing one thing. They're trying to do it all. They're trying to be a sort of one-stop shop for all of your energy needs. And yeah, you know what? They've done it for a long time and they're good at it. They're good companies. Do not get me wrong. But why would you buy them now? Why is now a good time? And I understand analysts want to be right. These stocks will probably outperform in the short term, but why would you be buying them while the stock price is high because everybody's expecting them to outperform? This is just another one of the many reasons why I think it's always a good idea to be a long-term investor. It's always a good idea to think about your time horizon. Okay, if you want to sell next year, you probably shouldn't be making a huge purchase of CNQ. That's fair. But if you're an investor who's going to dollar cost average, you're going to spread out investments, you're going to invest on a regular basis, the price going down is awesome because it has still got great future growth potential, which has now been elevated by a changing political and macroeconomic climate. And while Suncor will probably also outperform over the next 10 years, the price is higher right now because it's expected to. So you will get a worse price for similar performance if it remains similar. If Canadian Natural manages to outscale because they're part of the production chain, they're part of the energy ecosystem, is what ends up with a bunch of extra demand because there are new pipelines going to new refineries in different parts of the world, you're going to feel real dumb having listened to somebody saying that you should buy an integrated company at a high price. Those are just my thoughts. Sorry if I got a little bit heated there. I don't understand. I don't understand why we are buying things that have been priced in and why we are making these short-term decisions. Just because the word tariff is being used does not mean you should change your entire strategy. Take it slow, take a breather, invest for the long term. You're going to see better results than just chasing whatever analysts tell you to. That's about all I have for you folks today. If you enjoy that kind of content, you want to talk more about investing, please do subscribe to the channel and like the video. It makes a huge difference and doesn't cost anything. And with that being said, I hope I see you in the next video.